Hello and welcome back to Budgets and Beyond. We're peeling back the layers of investment jargon to make the world of finance more accessible. It's time to demystify these terms together. Let's start with the basics. Stocks and bonds. A stock is essentially a piece of a company that you own. It's a claim on the company's assets and earnings. Now imagine lending money to a company or government. That's a bond. They promise to pay you back, with a little extra for your trouble. So stocks are ownership, bonds are loans. Stocks and bonds are the bread and butter of investing. Next up, mutual funds and ETFs. Picture a mutual fund as a big pool where many investors contribute money. That money is then used to buy a diverse mix of stocks or bonds. Now imagine an ETF or exchange-traded fund. It's similar to a mutual fund, but it can be bought and sold like a stock during the trading day. Both mutual funds and ETFs offer diversification but with slightly different mechanics. Market capitalization or market cap is a term you'll often hear. It's the total market value of a company's outstanding shares. A simple multiplication of the share price by the number of shares. Companies often fall into three categories: large cap, mid cap, and small cap, depending on their market cap value. Large cap companies have the highest market value, while small cap companies have the lowest. Market cap gives you a quick snapshot of a company's size and potential growth. Dividends are another key term. They are slices of a company's profits distributed to shareholders. It's like a thank you note for your trust in the business. Now the dividend yield. This is a financial ratio that illustrates just how much a company pays out in dividends each year relative to its share price. A higher yield can mean a greater return on your investment. Dividends can be a significant source of income for investors. Ever heard of bull and bear markets? In the financial world, these terms represent the market's overall direction. A bull market signifies times of optimism and economic growth, with rising stock prices. Conversely, a bear market indicates periods of pessimism, with falling stock prices. These shifts in market sentiment are often influenced by a myriad of factors, including investor confidence. Bull and bear markets reflect the economic cycle. Index funds are worth knowing. These are designed to follow specific market indexes such as the S&P 500, providing a broad market exposure at a low cost. On the other hand, portfolio diversification is all about spreading your investments across various asset types. Think of it as not putting all your eggs in one basket. Diversification is a key strategy to manage risk in your investment portfolio. And there you have it, a quick guide to some of the most common investment terms. From stocks and bonds to ETFs and mutual funds, from understanding market capitalization to deciphering dividends and yields, and from grasping the essence of bull and bear markets to appreciating the importance of index funds and portfolio diversification. Knowing these terms is crucial for successful investing. Remember, knowledge is power in the world of investing.